We're now heading into the final Fed meeting of the year, and the likelihood of another rate cut is looking higher than it did even a week ago when it was very high. We can start with what matters most for the Fed. That's PCE inflation, personal consumption expenditures. This is the Fed's favorite measure of inflation, and it did come in a little lower than expected. Nothing dramatic, but at least it's good enough to support another rate cut next week. Shelter inflation, which it seems like we've talked about being overstated forever, does seem to finally be cooling off and catching up to real-time rental numbers as well. Gas prices did push headline inflation up a bit, but overall the report was right in line with what the Fed does want to see. And we also got some fresh consumer sentiment numbers from the University of Michigan. Households are expecting less inflation over the next year and even over the next 5 years, but my guess is they're not very in tune with the Fed ending quantitative tightening, which is usually something that helps bring inflation down. QT does drain liquidity and kind of nudges borrowing costs higher, which lowers demand and then indirectly does help inflation come down. My guess is people just think that prices can't possibly continue to go up at the rate they have, which is obviously understandable. On the labor side, things do continue to look soft, which is what you want to see if you're hoping for lower mortgage rates. The ADP report we got was weaker than expected, and Challenger job cuts showed a very high number of layoff announcements. It was actually the highest November number in years. And even though jobless claims did come in low, it was mostly due to it being a holiday week, which basically makes those figures irrelevant. But the bigger story is the actual trend. We're seeing less hiring, more layoffs, slower wage growth. All these things are a sign that the labor market's weakening, which should be good for mortgage rates. And in terms of home prices, Cotality's index showed a small month-over-month decline in October, but prices are still up slightly year over year. They are expecting about 4.5% appreciation over the next 12 months, which is meaningful, and I would guess that's likely because they are expecting lower rates that would boost demand. New rent numbers that we kind of talked about earlier do continue to move lower. Apartment List showed rents down month over month and year over year, one of the biggest drops we've seen in a while actually. And vacancies are also rising, and that can kind of lead to cuts in the rents that landlords are asking for. And this eventually, again, takes time, but it does bring inflation down, which again tends to bring mortgage rates down. And a lot of Fed commentary hit the wires, and markets are now expecting a 90% likelihood of that quarter-point Fed cut next week that I mentioned. But with that said, the Fed is really divided internally, and President Trump is expected to announce the next Fed chair soon. Kevin Hassett does appear to be the front runner, and he's widely seen as someone who would help push rates lower, at least more aggressively. And the only curveball we really got this week came from overseas when Japan hinted at raising rates, which did cause global bond yields to kind of jump and temporarily push U.S. Mortgage bonds lower. But next week, we're going to get the Fed meeting, the JOLTS report, and some inflation figures that have been delayed by weeks of the shutdown delays. But these will kind of set the tone for rates heading into the new year. But have a great weekend, and I'll see you next Friday.